Welcome to the Riskwiser Zone, the podcast where we dive into the world of finance and explore the latest trends, risks, and opportunities. I'm your host, Lewis, and I'm excited to have you join us today. We're living in uncertain times, folks. The global economy is navigating a complex web of trade tensions, inflation concerns, and fiscal stimulus measures. And at the center of it all is the United States, with its tariffs, dollar weakness, and treasury yields making headlines every day. Now, let's take a step back and try to make sense of it all. The U.S. tariff situation has been a major point of contention, with many experts warning of potential stagflation risks and a decline in household wealth. But what does this mean for investors? Should they be diversifying their portfolios, or is it time to take a more cautious approach? According to some analysts, the diminishing likelihood of fiscal consolidation in the U.S. could lead to rising global bond supply and weakening demand for U.S. treasuries as a safe haven asset. This in turn could trigger a major reallocation in global portfolios, with gold prices potentially benefiting from the shift. But here's the thing, we need to be careful not to get caught up in the hype. The situation is complex, and there are many factors at play. Central banks around the world are reassessing their dollar reserves, and the Fed may need to take a more dovish stance to respond to a deteriorating growth outlook. So, what does this mean for asset classes? Well, it's clear that the outlook for treasuries is less favorable, with yields potentially rising due to additional risk premium. Equities, on the other hand, will need to balance the drag from trade uncertainty against the growth boost from a reduced likelihood of aggressive fiscal tightening. As we navigate this uncertain landscape, it's essential to stay informed and adapt to changing market conditions. Companies with true multinational operations may prove more resilient, while domestically focused themes and banks that benefit from monetary easing could be worth watching. That's all for now, folks. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a critical conversation about navigating economic uncertainty, specifically in the context of tariffs and their impact on personal finances. As we explore this topic, it's essential to approach it with a balanced perspective, understanding both the challenges and potential strategies for managing risk. Our focus is on a detailed analysis that suggests tariffs can lead to retaliatory measures, which might negatively affect the market. This scenario presents a significant concern for investors, particularly those nearing or already in retirement. The key takeaway here is not to panic but to plan. By understanding historical patterns and worst-case scenarios, individuals can make informed decisions about their investments. For younger investors, the advice often centers around taking a long-term view, allowing the market to recover over time. This means avoiding the temptation to sell off investments at low points and instead letting the natural fluctuations of the market play out. It's also crucial for these investors to maintain a diversified portfolio, ensuring that their assets are allocated in a way that balances risk and potential return. As individuals approach retirement, it becomes increasingly important to shift towards more conservative investment strategies. This might involve allocating new contributions to lower-risk investments, such as bonds or treasury funds. While these investments may offer lower returns, they also provide a safeguard against significant losses during market downturns, which is particularly important for those who will soon be relying on their retirement savings. For retirees, the situation can be more challenging, with fewer options available to weather economic storms. However, there are still steps that can be taken, such as reducing expenses, considering alternative sources of income like reverse mortgages, or selling off non-essential assets to supplement retirement funds. The emphasis here is on flexibility and adaptability, finding ways to adjust financial plans in response to changing economic conditions. It's worth noting that while these strategies can help mitigate the effects of economic uncertainty, they should be tailored to each individual's specific financial situation and goals. Consulting with a financial advisor can provide personalized guidance, helping navigate the complexities of investment and retirement planning. In conclusion, navigating the impact of tariffs on personal finances requires a thoughtful and multifaceted approach. By understanding the potential risks, maintaining a long-term perspective, and adapting financial strategies as needed, individuals can better position themselves to manage uncertainty and protect their economic well-being. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a look at some key developments in the world of finance. As we've been discussing throughout the episode, market trends can be unpredictable and influenced by a wide range of factors. Recently, we've seen foreign portfolio investors, or FPIs, extending their investment in Indian equities, injecting a significant Rs 17,425 crore into the market over the course of a week. This influx of foreign investment is a notable development, especially considering the global economic landscape and the various uncertainties that have been affecting markets worldwide. On one hand, this investment could be seen as a vote of confidence in India's economic resilience and growth potential. The country's moderating inflation and optimistic forecast for an above-normal monsoon in 2025 are certainly positive factors that could attract foreign investors. Additionally, the easing of global trade tensions has likely contributed to the increased risk appetite for emerging markets like India. On the other hand, it's essential to consider the broader context and potential risks involved. The U.S. Federal Reserve's rate hike pause and the stable U.S. dollar have also played a role in boosting investor sentiment, but these factors can be volatile and subject to change. Moreover, the significant outflow of Rs 1.22 lakh crore from equities since the beginning of 2025 serves as a reminder that foreign investment can be fleeting and influenced by global uncertainties. In another development, we've seen Reliance Industries' subsidiary, Jio Platforms, making waves with its recent announcements. While this news has generated significant interest and speculation, it's crucial to separate hype from substance and carefully evaluate the potential implications for investors. As we conclude today's episode, remember that investing always involves a degree of risk. It's essential to stay informed, diversify your portfolio, and maintain a long-term perspective. Don't get caught up in the excitement or panic of market fluctuations. Instead, focus on making informed decisions that align with your financial goals and risk tolerance. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. Until next time, invest with caution.